Most investors believe they understand money because they understand the products they buy. They say, I know how a fixed deposit works. I know how recurring deposits or insurance plans work. And yes, they know the product. But knowing how a product works is not the same as knowing which product is right for you. That is the difference between product literacy and process literacy. Product literacy of fixed deposits means you know the features, the interest rate, the tenure, the penalties. Process literacy means you know the process of how to buy a fixed deposit from a bank or a corporate or a broker. Familiarity of the product or process alone doesn't make it safe or suitable for you. Think of it like driving. You may know how the engine works, but that does not mean you can design the safest car. Understanding the mechanics is different from understanding the process of safety. This confusion is rooted in something called familiarity bias. It is a mental shortcut that tells us, if I have seen it before or experienced it in the past, it must be safe. Our brains crave the comfort of the known. That is why most investors feel secure with fixed deposits or gold. Their parents used them. They see them advertised by trusted institutions. It feels safe, but that feeling can be deceptive. Familiarity is emotional, not factual, and that emotion can cloud your judgment. Let me share a story. A few years ago, thousands of investors lost their savings to corporate fixed deposits issued by little-known companies. These FDs promised just a bit more interest, maybe 1 or 2% higher than a bank FD. Investors thought it is an FD, so it must be safe. But when the companies defaulted, everything vanished. They did not lose money because they lacked knowledge. They lost it because they trusted familiarity. The word fixed deposit felt safe. But safety does not come from familiarity. It comes from due diligence. Now look at another side of the same bias. Debt mutual funds, regulated, diversified, and professionally managed, are still viewed with suspicion. Why? Because they are unfamiliar. Many investors do not understand how they work, so they avoid them altogether. And by avoiding the unfamiliar, they also avoid diversification, the single most effective way to protect and grow wealth. It is not a question of intelligence, it is simply human nature. Our minds prefer comfort over curiosity, but in investing, comfort can be costly. To build lasting wealth, you must break that familiar equals safe equation. Safety does not come from sticking to what you know. It comes from understanding the process, researching, comparing, diversifying, and evaluating risk objectively. When you diversify across equity, debt, gold, and other asset classes, you reduce the impact of any single failure. When you learn how to analyze a product instead of just recognizing its name, you step up from being a saver to becoming an investor. Think of your portfolio as a garden. If you only plant one kind of seed, say fixed deposits, the garden might look neat, but it is fragile. One pest, one drought, one corporate failure, and the garden is gone. A healthy garden, like a well-designed portfolio, needs variety. Equity for growth, debt for stability, gold for protection, and a dash of global exposure for balance. Something is always blooming. So the next time you tell yourself, I know this product, it is safe, pause and ask, do I really understand the process that makes it safe? Familiarity feels comfortable, but comfort rarely creates wealth. True investors move beyond what they already know. They replace familiarity with understanding and habit with intention. That is how you build wealth that lasts, not through what feels safe, but through what is diversified, disciplined, and thoughtfully designed. If you like such investment and wealth insights, please subscribe to this channel for daily posts. See you in the next video.